There is the unemployment rate, which is the household survey. At its low point, the unemployment rate was 3.4%. It's now 4.3. Well, that's an increase in the unemployment rate of 26%. Historically, according to the first-rate economist Nancy Lazare, Piper Sandler, in the past, we've had recessions whenever the unemployment rate increased by more than 10% from its low. And then there's the Somme rule and the McKelvey rule, which was really Somme rule was drawn from. The McKelvey rule shows outright that unemployment rate has hit the mark that typically is associated with recessions. The Somme rule, there's a little dispute as to whether or not it currently has or has not, but it's certainly very close. So the fact of the matter is you have a whole plethora of variables, but the one that the market has been trained to accept as the gospel is the payroll number. And so the number when it comes out is still going to be just as flawed as the number that was released for July, because there's no correction of the underlying problem, none whatsoever. Let's look at several critical areas. Look at vehicle sales, existing home sales, and new home sales. The current level versus their 5-year peak. The vehicle sales are down 13%, and the new and existing home sales are down 37%. That's a very significant decline. It's larger than the typical decline during a recession. Another thing that's happened, which is a reflection of not only domestic conditions, but conditions overseas, is that in real terms, the current account deficit, or net exports in goods and services, in the latest month is 8.5% deeper than it was a year ago. That's a high multiplier sector. You already have components of the economy which shows deep declines. And the presumption is that those sectors are doing well, when in fact they are not, in my opinion. I think in due course, the Fed is going to have to cut the rates more significantly than they think they are going to. I think ultimately the neutral rate, the real per capita growth rate, which is 1.3, and a 2% inflation rate suggests a low 3 number. But if the Fed proceeds in a very irregular fashion, or if they waver from time to time, or if they cut the rates and indicate that their view on the outlook is still indeterminate, people may continue to say, well, 5 1/8 is not 5 3/8, but it's still a pretty good return. It may not result in any sort of rapid shift. It may require a greater degree of indication from the Fed as to how they see the picture. And so it could be a very long, drawn-out process. As an investor, that the long-term process is what I'm concentrating on. But to those that try to trade it, it could be much trickier. Inflation rate is coming down, which means that the real federal funds rate is actually rising. And so a 1/4 cut, all that really does is partially neutralize the reduction in the increase in the real rate that has occurred when the nominal rate was unchanged and the inflation rate was coming down. And so I think that also suggests the Fed is behind the curve. Both are proposing increases in the national debt, and that will send us further down the law of diminishing returns. And it's really not clear to me who has the plan to increase the debt the most, but both of them have big plans, expensive plans, and no effective way to pay for them. Totally opposed to raising tariffs is a contradiction of the law of comparative advantage. You raise the tariffs any significant way, you force retaliation. It's an ill-advised policy. It's as ill-advised as instituting wage and price controls. It's so contradictory to fundamental economics to do either one of them. But it's an indication of where these two parties are now. They're not where they used to be. They're proposing programs that will make the situation worse than better. Now, with regard to the increase in the corporate tax rate to 28, increasing capital gains rates, not just on realized, but on unrealized gains, we have to remember several things. First of all, capital is mobile. Capital doesn't stay in the United States because we're pretty. It stays in the United States because the after-tax rates of return are attractive. A 28% tax rate, according to the research of Nancy Lazare, will give us the highest corp rate for any country except Colombia, which is a very minor country. So, but in addition to that, if you raise the corporate tax rate, you raise the cost of production. So when you raise the cost of production, then firms will attempt to raise prices. In the current environment, they're not going to be able to raise prices because money supply on a detrended basis is declining, which means that this will impinge their profit margin. So in short order, as a result of the corporate tax increase, it will force firms to relocate their capital overseas. That's what they will do. We're seeing a huge dichotomy in the performance of the high versus the low tax states, which is an indication that even though it's difficult, capital will move. And it will move within the side of the United States, but it will also move from the United States overseas. Well, it's capital that creates jobs. It's capital that creates prosperity. So if you want to tax it and say you're going to help pay for some of these benefits, the fact of the matter is it's not clear that the higher corporate tax rate after a few years will generate more revenue. I would say it will generate less revenue than if you had done nothing. So we're basically locked in. Another thing that concerns me is wage and price controls. And one of the fundamental laws of economics is the law of supply. And it says if the quantity supplied is positively related to the price. So if you lower the price, the quantity supplied will decline. There's a positive correlation. That's the law of supply. The law of demand is inverse to price. You raise the price, the quantity demanded declines. So when you lower the price, the supply that is going to be provided is going to go down and there will be greater demand. But that means that the gap between quantity supplied and quantity demanded will be greater, which means you created a situation that then demands in the second phase, not in the first phase, but in the second phase, higher prices. And so you end up with higher inflation. And if the Federal Reserve did what it did when President Nixon imposed price controls in the 1970s, then you will shift the nominal demand curve out and you'll get higher inflation from creating a shortage of goods as well as from the printing of money. Anyone that thinks that wage and price controls are beneficial, they are only momentarily, because when you lower the quantity supplied, you get a reduction in the quantity supplied, but you're simultaneously getting an increase in the quantity demand, and consequently the fundamental gap between quantity supplied and quantity demanded gets greater and you have a shortage. Fundamentally, then, whatever short-term benefit there is in imposing the price controls, you lose it and you go to higher prices until the market price is restored. And so fundamentally, it puts the economy in a highly unstable situation. And if the Federal Reserve lower the inflation rate because of the first round effects of the price controls and the Fed revs up the money supply, then you've made the situation even worse, which is what happened in 1972 when Richard Nixon was president and Arthur Burns, who was chairman of the Wage and Price Control Committee, accelerated the money supply growth. And the effects were very, very harmful. And after about a year, the wage and price control started failing, and then Nixon then withdrew them, and then the inflation rate shot up very, very dramatically.